Wadsworth here with a presentation on the opportunity of consumer financing for your business, your retail business. Thanks a lot for coming in, and hopefully we can give you a little better understanding about exactly what consumer financing is, what it can do to help build your bottom line, and also some of the details as to exactly how it works and what it can do for your business and what it might not be able to do as well. Why don't we just dive right in here and just talk exactly about what is consumer financing and what is the purpose of it. Quite simply, the purpose of it is to convert more prospects, more shoppers at your business into paying customers. And the way that it does that is it removes the objection of having a lack of money to pay for a particular good or service by offering financing to help them get that through a monthly payment plan, which is essentially a loan that's paid back over a period of time, anywhere from 12 months to 72 months. So it allows retailers and merchants with high ticket items, usually $1,000 or over, an avenue to make sure their clients can pay for those goods and services. And that service, that retail financing, is offered right at the point of sale. So it's something that if they're in the store, and especially if there's marketing letting them know that there's a payment plan available, you'll find people will ask for it, but they have to know that it's there in the first place, which obviously means that retail financing fits into your marketing, your signage, and all those sorts of things. They'll let people know that they can pay, certainly pay up front with cash, but there's also an alternative if they don't have room on their credit card or don't have a credit card available at all. 80%, kind of speaking to that, 80% of consumers cannot pay cash for an item over $1,000. Just the way it is right now, with incomes falling and the credit situation still pretty tight. Most are going to try and pay with a credit card or will just leave without any alternative financing source. Those of you who may be lined up with some local banks to help your customers out with this, traditionally they're going to turn down about 70-75% of those folks, especially in today's restricted lending environment. So the kind of loans that were getting made 4 or 5 years ago aren't getting made anymore, which has really led to an explosion for this type of demand for retail financing. It's been around for a long, long time, at least 50 years. Jewelry stores, furniture stores are big users of it. But now that not everybody and their brother is being offered a credit card by a bank, it's making a huge comeback, primarily, as I just said, due to that restricted consumer credit card lines and the fact that most people's home equity, which is how a lot of these large purchases were previously being made, has just evaporated. Housing prices have collapsed, and with it, home equity loans are pretty much a thing of the past at this point, with a few minor exceptions. Okay, great. How does it work? Well, it's intended strictly as a business-to-consumer transaction. I think that's worth mentioning as I speak to businesses on the phone. Sometimes there's businesses out there whose main business is doing business with other businesses, like selling office furniture. This would not work for that, though. It's intended strictly as a business-to-consumer transaction, meaning it's for the consumer's personal use, not for a business purpose. So that's important to remember. The merchant will complete a application to become an approved merchant with a given lender who offers retail financing. That approval process is fairly easy, doesn't take a long time, maybe 7 to 10 business days once the application is approved. It's pretty much your typical due diligence check just to make sure the lender knows who they're doing business with. Upon approval, the merchant's going to accept applications at the point of sale via online or a paper application, perhaps in a home improvement situation. Those applications will be submitted via an online portal, or they can be sent in via telephone fax. Decisions on those applications normally will come up on the online portal virtually instantly in some cases. In other cases, it may take a little bit longer, as much as a day, depending on the credit quality of the particular applicant, but most of the time it does come fairly quickly. Once the merchant knows that that client is approved, they can print out the loan documents and have the customer sign them directly at the point of sale, and those loan documents will be available via the online portal. So it's very easy, very convenient to get everything completed right in your store or even in a customer's home and in a home improvement type of situation. Funding to the merchant occurs in most cases within 72 hours via ACH or wire transfer. It's a little bit different depending on the lender, but generally speaking, it comes fairly quick once the completed paperwork is received. And then the customer down the road, 30 days down the road, is going to receive a monthly bill just like they would for any typical credit account. So it's no different than any other bill that they may pay on a monthly basis, and as they make their payments, their balance goes down and the loan is paid off. Types of businesses that are eligible for retail financing, consumer financing, whatever you want to call it, the list is very, very long. So I didn't bother putting that here, but just to give you an idea of the types of programs we offer, anywhere from a discount travel club to a home improvement contractor, to somebody who may be doing heating and air conditioning, to somebody who may be doing consumer furniture, jewelry, products and services, way too numerous to mention. So if you have a question about something you think may or may not be approved, just shoot me an email, give me a call. One other thing is, generally speaking, startups will not be allowed. You need to be in business at least 1 year. So what are the benefits to a merchant? Well, if you haven't figured it out yet, really the biggest benefit is creating customers out of people who previously would have walked right out the door. They wouldn't have said anything. Very few people are going to come out and say, I can't afford it, or I know my credit isn't great, I won't get approved. They'll just walk out. So if you're letting people know that you can approve a wide range of customers and that you do have financing, you're going to see increased revenue and a higher conversion rate for higher gross revenue and an increased customer base for your store. And let's face it, that's all why we come to work every day, right? So you can convert a lot more of those lookers into buyers with a solid financing program in place. In most cases as well, there is little risk. Most programs are non-recourse, meaning that once the customer is approved and funded, there is no risk to the merchant down the line if that loan goes into default later. Some programs for particular business types may have a recourse provision in there. They may have a reserve provision in there for anticipated losses. Typically, though, you're going to know everything about that before you decide to move forward, and typically the programs that offer that kind of recourse arrangement are very high margin type of products, but also high risk type of products. So it still makes sense in most cases for a merchant to move forward once they understand exactly what the parameters are for their particular program. What are discounts? Well, discounts are a fact of life in any consumer financing type of program. Really just what changes is the amount of the discount, but discounts are a discount to the amount requested by a merchant. A very simple example right in front of you. If $1,000 is requested and the approval is granted based on a 5% discount, the net amount to the merchant would be $950. Discounts can range anywhere from a low for the very, very best credit quality customers of 2.5% to a maximum of 30% based on credit quality. And that would be for somebody at the very low end of the credit scale. Now, keep in mind that no merchant has to finance anybody they don't want to, even if they have an approval. So you're not locked into anything. Really what the lender is just telling you is what is possible for that particular applicant. Discounts are a fact of life with almost all consumer financing programs. From the best credit to the most difficult credit scenarios, discounts are usually going to be present in every approval, from a AAA rated to somebody with a 550 credit score. Even manufacturers financing programs that may not advertise that they have any discounts have other ways to make up for that, either vis-a-vis the interest rate or by other charges that they may tack on, such as an origination fee. They also make up for it by the fact that they usually, manufacturers financing programs, for those of you out there who have those, usually will only accept the absolute best credit, which at this stage of the game means that probably anywhere from 60 to 90% of your application is, depending on where you live and what type of product you have, may be getting turned down by a manufacturer's finance program. So a secondary source, which we also handle here, may come into play for those customers who don't necessarily have the best credit. And the key to any business in terms of discounts is understanding what their profit margin is and how financing can increase the bottom line. Businesses with high margin products, somewhere north of 40%, and services have more leeway to finance a wider range of customers that may require large discounts because they can still sell their products and services profitably. In other words, a customer who may not get approved on a AAA rated financing program may get approved on a secondary source at a slightly higher discount. However, it still makes sense for that business to sell to that customer and absorb the additional cost of financing because they're still making a profit. Much better to make a little less money than to make no money and let a customer walk out the door. There's also something to be thought about. The lifetime cycle of that customer is, even if you bring them in at a lower profit margin now, there's nothing to say that a year or two down the road, when they may be coming back, they may be in better shape or may be able to pay cash. So it's not just the customer who walks in today. The old adage is you don't sell them just one car, you sell them 5 cars throughout their lifetime. Really rings true, I think even more so today. Businesses with tight margins may only wish to finance the best credit customers, and that's their prerogative, who normally have a very low discount. There are few, if any, financing programs that do not use discounts as a way to share costs with the merchants and manage their default risk, or the loans going bad, in a very challenging consumer credit environment. So if you're looking for a zero-cost financing program with no cost to the merchant whatsoever, chances are it will be a hard search, unless you're with a manufacturer's type of program, and even then there are costs associated with it. The key to remember is, are the costs, is the opportunity presented worth the costs involved? Will you bring in more gross revenue, even spending a little bit more per customer? The answer has to be yes, or it doesn't make sense for you to do it. Key facts to understand, and this kind of goes into that as well. Financing enables more sales conversions. There's no doubt about that. Some of these conversions may be at a lower profit margin, but are still a far superior alternative than no sale at all. There are programs for perfect credit, middle credit, and difficult credit, as well as unusual companies such as discount travel clubs, auction houses, and as seen on TV type of products. Successful companies, merchants that use financing really understand their bottom line and know exactly what level of discount their products and services can absorb and still be profitable. And kind of going into that, many of today's consumer financing programs and products make it very easy to calculate your pricing based on what you think your average discount will be once you understand the program. And then you'll be able to quote payment ranges directly to the customer at the point of sale. You also may be able to finance in some of that discount, so you'll be able to get to the profit number that your particular store needs to hit. You can also get your consumer loan documents printed out very easily and signed right at the point of sale, so you can fax them into the lender, send them into the lender, and make sure you get your money. There are no zero-cost consumer financing programs. It bears repeating. While many programs may not have a sign-up fee, other costs such as discounts are almost always a part of each deal. The question for any business, once again, is whether this opportunity cost will enable higher gross revenue and more sales. For many companies, merchants, the answer is definitely yes. And that's really all I have to say on the topic today. However, if you have any more specific questions, give me a call, shoot me an email. My name is Neil Coxworth. I'm with Silver Streak Funding. You'll see the number right there on the screen. And you can also look around the website if you have any more questions. Other than that, though, I thank you very much for coming in today and learning a little bit more about consumer financing. Hopefully, we've answered a good portion of your questions. If you have any others, let me know. Other than that, you have a great day, and thanks for listening.